Hello, everybody. Welcome back to another episode of the Breakthrough Advisor podcast. Man, I'm excited for our guest here today. I'm your host, Randy Yost with Simplicity InsurMark, and joining me today is industry expert and director of advanced markets for Simplicity. Welcome to the podcast, and thank you so much for joining me, David.
Thanks for having me, Randy. It's a pleasure.
Absolutely. Now, I'm excited because we're going to talk a little bit about the One Big Beautiful Bill Act, or also known as OBBBA. This landmark legislation introduces notable tax changes that every financial advisor and professional should know and absolutely get to understand. Today, we're going to, you're going to gain some timely insights into what the One Big Beautiful Bill Act means for your clients, of course, for you, and how it can unlock new opportunities to grow your retirement planning business. So as we jump into this here, before we dive into today's topic, David, of course, folks, if you're not familiar with him, he's got more designations behind his name than a beach has sand. He's JD, AEP, CLU, ChFC, CAP, FLMI. The list goes on. But before we get started for our listeners, obviously, I know you being a partner at Simplicity, but how did you get into the business? For those that aren't familiar with you, what exactly it is that you do? Would you mind sharing a little bit about your background and what's led you here to Simplicity with us?
Absolutely. Appreciate it. So I got into this industry in 1991. To give you an idea how long ago that was, a lot of my first year was spent faxing illustrations to people. So for those younger, a fax is, never mind, I won't go into that. So yeah, it was a long time ago. I've been doing this about 34 years. I quickly realized that if I have a gift and a talent within this industry, it is putting together, solving puzzles. It's not necessarily some of the other aspects of the industry. So I realized that I love the tax and legal side of the things. And yes, that means I'm a nerd. That's what I am. I'm owning it. And so I went to law school and I just furthered my education, learned all I could about the tax and legal side of the financial planning, about psychological behavioral finance, about anything and everything I could get my hands on. And I've spent most of my career either being an advisor or supporting advisors. And so I joined Simplicity. It's been 2 years now. One of the great things about Simplicity that I enjoy is, since I enjoy putting the pieces of the puzzle together and solving and being a planner, I like to be agnostic when it comes to product. I like it to be agnostic when it comes to the solutions. I just want to solve people's problems, help them reach their goals, mitigate risk, and all those kind of wonderful things, and kind of make simple the complex. And so it's best done in an organization that has, it doesn't really matter what the financial product is, assets under management, insurance, annuities, doesn't really matter. Long-term care, DI. It only matters if we get it right for the client. So I appreciate that side of it. And that's why I am where I am today.
Awesome. Yeah. And that's what we're all about here at Simplicity, folks. It's all about creating better client outcomes, creating better advisor outcomes, helping you to build, scale, and ultimately capitalize on your business through probably, the three most prominent components of every organization, right? That's marketing, sales, and operations. And today we're talking a little bit about how to leverage the One Big Beautiful Bill Act to increase sales and create new opportunities. If you would, David, maybe share with us, our listeners out there, what exactly is the One Big Beautiful Bill Act, and what's the impact that you feel it has on advisors today? Any big picture thoughts about that?
Yeah. Big picture, what I would say is just to keep in mind that what this is it was a necessary tax legislation because a lot of the provisions of the 2017 Tax Act were going to sunset in 2026. So right from the get-go, they had to do something. And the administration, Congress, et cetera, decided to go down this road. There's a lot in there. There's way more than we'll have any opportunity to discuss today. There are provisions in there for every level of income, business owners, potential donors to charitable organizations, high income, low income, et cetera, organizations, et cetera. So yeah, there's a lot in there. What I would say, big picture also as well, there's a lot of misunderstanding about what was in there because there was a lot of misinformation flying around. That happens with every major piece of tax legislation because there's a lot of proposals, committee hearings, things like that. And then a lot of people want to be first instead of being right. So the news puts out what they hear first. And next thing you know, that wasn't necessarily right. So your clients, if you're an advisor, your clients may have heard one thing and it may not be necessarily true. So that number one, and number two, number three, I would say a lot of what's in there also expires. So, and there's a lot of details to it. So where you might hear a blanket statement about a particular provision in the tax code now, there are details to it. So pay attention to the details. So big picture, don't make any generalizations. You have to know the details of it. So yeah, that would be my big picture.
Yeah, that's good advice. What's the one constant in life? That's change, right? And that's ever evolving. What do you think? And I guess what are some of the provisions that might have an impact on, the typical client that our advisor clients connect with? Any thoughts on that?
Yeah, just from a basic standpoint, they extended the 2017 Tax Act, the rates. They're extended indefinitely. There you have a higher standard deduction in 2025, actually, so that'll be helpful for some folks. It bumped up $750 a person, $1,500 for a couple. There are three new tax breaks that got a lot of publicity, and that's the tax breaks on tips, tax breaks on interest for car loan deductions, and the tax break for overtime. We don't have a lot of time to go into all the details of those, but if you have clients that have revenue income based on those things, you have some new tax advantages. I will say this: all those three that I just mentioned actually end after 2028. So one thing I'll just note about that real quick too is, like, we talk about tax planning, we talk about financial planning. If you're a CPA and you're a tax planner, you can plan annually. You that's the idea. Like, what are the tax laws today? How do I avoid paying, mitigate my tax liability this year? As financial planners, we have a longer term time horizon. We're trying to achieve a goal, whether it's retirement planning, education planning, estate planning, business planning, all those things. And so a lot of these that I'll talk about, they're useful for a CPA to know what your taxes will be this year. From a financial planning standpoint, well, if it ends after 2028, there's not a lot of planning to go on there, not a lot of long-term planning. It just helps you to know those things. And, your clients want you to know some of the tax laws. So some of the basic things that I just mentioned, that's just more for the CPA world. We should know about them, but as far as planning goes. But there's some other smaller ones in there too. It expanded some of the 529 plan rules. Helped, you can do $20,000 annually. It extended it for K through 12 expenses. So from an planning for education standpoint, look into the 529 plans again. It created this thing, and this was talked about a lot, these Trump accounts, which are essentially like an IRA for newborn children, right? Starting them off early, where the federal government, if they're born between this year and 2029, they'll put $1,000 into it to a newborn child, and you can put $5,000 into it. And it's to get the children actually to have, it's taxed like an IRA. So to get them some retirement savings really early. So that's interesting. Now, the one I'll say that I want to expand on just a little bit is there was this comment that, hey, Social Security taxes Social Security isn't going to be taxed anymore. That's not true. That's not the way it works. They created a $6,000 deduction for seniors age 65 and over. And that has the effect of, for some people, mitigating taxes on some of their Social Security benefits. Now, it has an AGI limit, and this is one of those things you have to pay attention to. So if you are single and make $75,000, or you're married and have make $150,000, and above that, they start to phase it out. So that $6,000 deduction for seniors phases out for those who make a fair amount of money. So you said for the most, your common client, I'm not going to call those low-end income people, but for, seniors age 65 and over, it does that. Now, here's what I want to expand on. Is that important? Sure. But this whole idea of Social Security, and I know I talk about advanced planning, estate planning, business planning a lot, so I don't get into this too much, but I will tell you this. There's a lot of, communications out there about the Social Security Trust Fund. a lot of misinformation about Social Security Trust Fund. And if you read into it enough, you'll read something that says that the Social Security Trust Fund is going to be depleted by 2034. Usually that's the age or about the year that they talk about. This new provision on not taxing seniors for $6,000 above age 65 actually has the impact of bringing that down a year. So it's more likely 2033 that the Social Security Trust Fund, which is not a bank filled with a bunch of money, you have to understand what it actually is, will be depleted that much earlier. So if they're going to increase the retirement age of Social Security, if they're going to reduce the benefits of Social Security, if they're going to increase the taxes on Social Security, whatever they're going to do, it just got increased, moved up a year. So what does that do for a financial planner? Social Security is one of those things that provides you lifetime income, whatever it's supposed to be. That's at risk. And I think a lot of people in the 55 to 65-year-old age are concerned about that. What do you do about that? And so as financial planners, I think we should be aware that they're going to have to address Social Security. And this new tax law, when we talk about the OBBBA, exacerbated the problem, so to speak, if you agree. That's not a political statement, it's just math. So if I'd say anything to those clients, retirement planning and Social Security, take a second look at that and make sure that you're providing lifetime income.
Yeah, I think that sounds to me like an opportunity to have a conversation and educate not only, of course, prospective clients, but also, of course, existing clients, and just to have those further conversations about planning and the things that can be done to make sure everything aligns. How does it open doors to new market opportunities and sales strategies for maybe the mass affluent? I know we talked about kind of the everyday, but what about the mass affluent, and what are some of the planning opportunities that you see for these clients and prospects, also known as, I guess, what we call Henry's, high earner, not rich yet, like doctors and lawyers and, maybe some of our financial advisor clients, if you will. What are your thoughts on that?
So the first thing I think advisors have to get away from, especially those that were raised in this industry in the 90s, is stop talking to the mass affluent about estate taxes. No matter what you project their growth in their estate to be, based on the current estate tax exemptions, which will be in 2026, $15 million, $30 million for a couple, instead of focusing on estate taxes, focus on income taxes. All right. So some of the provisions in there, for example, that will actually help that group out is the SALT tax deduction. So the state and local tax deduction. They had capped it at $10,000. Now they bumped that up to $40,000. Again, I have to caveat almost everything I say. In this case, I have to caveat by saying it's through from 2025 through 2029. So for planning purposes, keep that in mind. There's some different tweaks they did with the AMT, and I'll get to itemized deductions in a moment, but income tax planning is going to be the name of the game. One of the things this did, and if you do any research on this, what you'll come across is this term non-grantor trusts. So if you have mass affluent, and I'm not talking about 3 to 5 million, I'm probably talking about 5 to 10, and you have some real state and local taxes to deal with, some of the states that might have higher taxes that are maybe above $40,000, and they want to be able to deduct more of it. There's a strategy that's going to become very popular, if it isn't already, called creating, non-grantor trust. It's essentially setting up a trust that is a separate entity from you with a separate taxpayer identification number, and moving assets that generate these potential SALT deductions into those separate trusts. You wouldn't just create one, you might create multiple. Maybe if you have 4 kids, you move it into 4 different trusts, something along those lines. And a non-grantor, most trusts that we're familiar with are actually grantor trusts. These non-grantor trusts are separate from you from a tax perspective, income tax perspective, so that you can actually deduct more than $40,000. So you're going to hear a lot about that. Tax shifting is going to be a very popular topic, and that's one of the ones you're going to hear a lot of. And it'll work. The OBBBA made sure that is still a viable solution. So the mass affluent are going to be looking at shifting tax, their income tax, and non-grantor trust is going to be big. They did, and I'll get to this at a later time here if we have a moment, but they put a unique cap on itemized deductions. So the maximum benefit you can get from an itemized deduction is 35%. And if you've paid attention to tax rates, you know that the highest tax rate is 37%. So the income that you're earning above the base that gets you to 37%, if you have itemized deductions, you can only get a 35% benefit. I know that sounds confusing and the math is a little bit weird, but they put that cap on there. And if you think about what do you itemize, one of the items that you itemize from a deduction standpoint is charitable giving. So we can chat about that later, but charitable giving, if you donate and you're in the 37% bracket, you just lost 2% of that advantage right there. And so that was a little tweak that wasn't advertised very much. But it doesn't go just for charitable giving itemized deductions, but anything you would deduct that way.
Sure.
So that was a little bit of a tweak. One more comment on this. They did put a cap on, and this was unique. Again, there's a lot of hidden provisions in there that unless you're in that world, you wouldn't have noticed. They put a cap on government loans for education, subsidized and unsubsidized loans, specifically for graduate students and professional students. So the professional is law and medical for the most part. And the caps that they put on there, frankly, doesn't cover it. You can't borrow the full amount of some of the higher education is costing so much these days. You may not be able to get a loan from the government. And if you can't get a loan from the government, you're going to have to get it from a third-party lender, which is going to be a lot higher interest rate. So one of the planning points, I've already put this out to a couple of different clients that I've had an opportunity to speak to, is why don't you create a trust? A lot of grandparents, care about education of their grandchildren, et cetera. Why don't you create a trust fund that provides for education for kids, grandkids, great-grandkids, make it a dynasty-style trust in perpetuity if you can. And it doesn't have to necessarily distribute funds for education, although you could do that, but it could provide low interest rate loans. Because a lot of people who are professionals like a doctor or lawyer might want their kids or grandkids to be professional, lawyers or doctors. And so if they can't get the government loans because the cap's been put on it, they're going to have to go to a third party loan. What happens if, 10 years from now, interest rates are exorbitant? What if we go back to the 70s and the 80s specifically, and we have 11% interest rate? Wouldn't it be nice to have a bucket of money that they could borrow at, say, at 3%, 4%, where you can just make a distribution for that? So I've had an opportunity to talk about that. And again, some of these tax provisions, they're just talking points to go talk to a client. So that's one. If you have, kind of a high net worth individual that wants to talk about education planning for grandkids, well, did you know that the government just limited the amount that the government can lend for graduate level and professional level loans? So I thought that was an interesting point.
Yeah, very much so. And obviously, folks, I think what our listeners picking up here, David, is that there are a lot of moving parts. So the details do matter. And if you're looking for resources, we've got a fantastic summary piece that we can share with anyone. Feel free to reach out to Simplicity InsurMark and ask to speak with an advisor development consultant. We can provide that summary for you. It's a multi-page about different aspects of this act. What we've talked a little bit about the everyday client. We've talked a little bit about the mass affluent. I'm going to move on to high net worth clients. What are your thoughts maybe around wealth transfer planning for higher net worth folks? I know obviously there's there's always opportunities, and some of the advisors that we serve, of course, they focus on different types of client segments, but thoughts on the higher net worth folks?
Absolutely. So first, I already mentioned this, the estate tax exemption in next year is going to be $15 million, $30 million for a married couple. If you do the math on that, that means we just got in 2026, an additional $1 million, $2 million if you're married. So for a lot of folks, that means they don't have an estate tax problem. But for those that do, and I'm getting more calls than ever, people worth 50 million, 100 million. I've spoken to more billionaires over the past 6 months than I can ever recount. So the wealth is there. They're there. It may not be your everyday client, but they're there. And if you're 50 million, 100 million, all these same estate tax planning opportunities are there. Sales to defective trust and slats and all those kind of wonderful things we talk about. But keep this in mind. If it went up $1 million next year, there's a lot of clients like that have already used up their exemption. They went to talk to their estate planning attorney. They talked to their financial advisors. They already gifted non-voting shares in their company. They gifted an asset. They did something along those lines. They already used their exemption. Well, we just found $2 million more of exemptions. What can you do with $2 million worth of an exemption in 2026? You can pay an awful lot of life insurance premium. You could, a lot of these life insurance trusts were funded with not gifts, but they were funded with loans, private loans. Why? Because they already used up their exemption. Well, now, if it is a loan, you can forgive $2 million worth of the loan, treat it as a gift, use up the exemption. Private split dollar, it's the same thing. So there's all these different ways that you can utilize the new exemption that's just all of a sudden going to appear in 2026, number one. Number two, every single year after that, it's going to go up based on inflation. And if you just do the math on $15 million, $30 million for a married couple and apply 2.5% inflation, that's $750,000 every single year, and it's going to be more than $750,000 after that. So I spent a good portion of my career, especially in the 90s but in early 2000s, trying to find ways to avoid paying a gift tax on premium dollars going into an ILET. Don't have to worry about it too much. Every single year you get $750,000 additional exemption. So that's really, really not going to be a key part of what we do. I mean, we will for the $100 million client because they just run out. But there's a lot of different ways to use that exemption. So pay attention if you have a high net worth clients. They might have a little bit of estate tax and estate planning exhaustion. But when this exemption goes up, it's going to be good for them to move assets out, especially highly appreciated assets that can highly appreciate, stock that's currently private that could go public. Those kind of things work well in those situations. So removing them from not just their estate for estate tax purposes, but the other planning point that I want to make here is the thing that I talk to high net worth clients more so than even estate taxes these days is creditor protection. And it's not just creditor protection for themselves, it's creditor protection for their beneficiaries, for their kids. They want to do what we always say is keep the family wealth in the family. What's the quickest way to lose family wealth? It isn't estate taxes. It's creditor protection. It's creditor losses. Oftentimes that means divorce. You can lose 50% of the family wealth pretty quickly. And so there's a lot of different planning strategies that we talk about all the time. Beneficiary controlled trust, self-settled trust. There's a whole bunch of different ways to create a lot of creditor protection. So for that affluent family I was talking about before, it's obviously not estate tax anymore. It's absolutely income taxes. For this group, it is income taxes for sure, but it's also creditor protection. You get that much wealth, you get $50 million, $100 million plus of wealth. They're worried about someone attacking it, not just the IRS.
Yeah, no doubt about it. And there's a lot to unpack there, folks. So again, we have a ton of resources around the concepts that David's talking about. So be sure to reach out to your advisor development consultant here at Simplicity InsurMark. Now, you mentioned earlier a little bit about charitable giving, and that you could go into a little more detail. For our listeners out there, anything additional that they should know about the One Big Beautiful Bill Act, specifically as it pertains to charitable gifting?
Absolutely. So this is something I spent 8 years of my career in this 34 years when I wasn't faxing things early in the 90s as an independent consultant for charitable organizations in the mid-Atlantic area where I live. So I have an affinity towards charitable planning. One of the things that I think it's important for people to know, financial advisors to understand, is the 2017 Tax Act. When they made changes to the charitable giving tax laws then, it actually, and these are estimates, but the estimate was that charitable giving fell by about $20 billion in 2018 alone. That's a yearly drop. And because some of that was funneled into 2017, they think that the permanency part of that was about $16 billion. So we're losing $16 billion a year, estimated, from the 2017 Tax Act. All right, so now we have an extension of that, number one. Number two, we have there's two different provisions in the tax. There's three, actually. I'll hit two of them first. There is a 35% cap on itemized deductions, number one. Number two, there's this odd thing in there that they put 0.5% of your adjusted gross income is not deductible. Okay, so right off the bat, you're giving to charity and you want to claim a large deduction. Maybe you sold your business this year. Maybe you did a Roth conversion this year and you're deciding to give a large amount this year. 0.5% of your adjusted gross income is now not deductible when you make that charitable contribution, and you get limited to 35%. Now, what does that do? That cuts down your motivation, your incentive to give to charity. So there are estimates that say that that's going to knock down charitable giving again. Now, there's another provision for the lower end. So you can get now $1,000 deduction for non-itemizers, $2,000 for a married couple starting in 2026. That's cash donations, not to a donor advised fund. So all of a sudden, anybody, and we'd lost that. So if you give $1,000 and you don't itemize, go ahead and deduct it. So what they're expecting is the low end gifts are going to increase because now you can deduct it. The higher end ones are going to be maybe knocked down, and they think that the net effect of that is lower charitable giving. So if we were already down 16 billion and we're going to go down a little bit more, what does that do? And I want you to start thinking about the charitable organization themselves, not just the client. They're going to need some help. So I worked with charitable organizations in the past. I think it's very possible that some of them are going to get rid of their development staff. They won't be able to afford them. So they're going to look for outside parties. They're going to look for outside help. They're going to look for financial professionals to be able to come in there and be knowledgeable about charitable giving, and maybe talk to their high-end donors to motivate them, incentivize them, et cetera, and talk about some of these things. So that's what I think is going to happen. We're going to have a lot of opportunities to work with charitable organizations because of what the OBBA is going to do and some of the net impact of the 2017 Tax Act. They did some other things with charitable planning where they are going after the endowments of some of these universities. They increased essentially the excise tax on endowment funds. The larger the endowment fund, the smaller number of students, the bigger the excise tax. So they're going to do that. So universities are going to be figuring out, what do we do with this? On top of the 35% deduction limitation, on top of the 0.5% AGI limitation, et cetera. So a lot to know, a lot to understand. And also I'll say this, people are going to start lumping, just for the immediacy of it, they're going to start lumping charitable gifts into 2025. That's going to be a thing. That's a thing they're talking about now. In mid-September, we're almost getting to the point where it's too late. If you have clients that are thinking about charitably inclined and think that they might want to make a substantial donation this year, and they're thinking maybe I'll do it next year, it'll behoove them to do it this year. I'll leave it at that.
Wow. Yeah. I mean, I'm just hearing idea after idea after idea here, numerous opportunities to go and speak to your clients. What an opportunity. I know obviously there's going to be a lot of advisors that are trying to sift through and better understand, or they're not interested in staying ahead of the curve, so to speak. David, thank you so much for sharing this information with us here today. Any closing thoughts that you have around the One Big Beautiful Bill Act that we've been talking about, and how our advisors can leverage this to create new opportunities and ultimately increase sales? Anything else to talk about here with us here today?
Keep in mind that there's a lot of provisions in there for businesses. They increased the 1202 number. So Section 1202 says that you can sell a C corporation. There's a lot of rules to it. I won't get into it too much. And avoid capital gains tax. And it used to be $10 million of capital gains tax you could avoid. Now it's 15. And they expanded it. So what we're going to see is we're absolutely going to see business owners going to their attorneys and CPAs and saying, should I be a C Corp? Should I be an S Corporation? And here's the sales idea with that. That means we're going to have a lot of businesses considering a change. If you consider a change, that means you're going to have to change all of your corporate documents. So your articles of incorporation, partnership agreements, et cetera, which also means you're going to have to change your buy-sell agreement. If you're going to change your buy-sell agreement, somebody needs to be there to make sure you review it, to make sure it does what it wants to do, what you want it to do. I can tell you, I review these things for a living. 90% of them have faults in them. So it's an opportunity. They'll be looking to change. They'll be considering different things. And just use these tax provisions as a marketing tool. That's what we're doing. There's so many different provisions in there. There's provisions in there for farmers that I didn't talk about. There's provisions in there for deductions for various different things. Take note of some of those things. Use as an opportunity to talk to your clients. I'm sure they don't know all the details of it. And it's first to market here. The first one to come and bring up the idea and tell them about it is the first one to present ideas. And you want to be the idea merchant here. You want to be the one to talk to your client about that. And sales will follow from that, and good planning will come from that.
Awesome. Outstanding. Well, again, thank you so much for sharing all this wisdom here. I know you spent a lot of time sifting through the One Big Beautiful Bill Act to pull these nuggets out for us. Folks, if you're interested in learning more about the opportunities that you can leverage, be sure, again, to reach out to your advisor development consultant here at Simplicity InsurMark. We have a fantastic, again, summary of the One Big Beautiful Bill Act that you can obtain by reaching out to us, and we'll share that with you, as well as all the other resources and tools that we have to help ambitious life, annuity, long-term care, and wealth advisors to build a more successful and sustainable retirement income business. If you're interested in talking about maybe some of the Social Security planning opportunities, we have workshops and presentations, as well as, of course, a lot of different tools and calculators you can tap into. Income tax planning conversations, that's another big topic that David touched on with us here today. We have tools and resources really to help you not only educate you, but to help you market, help you convert more, and of course, ultimately continue to build and scale that business. So for today, for this episode, that's all for us here today. But David, again, I'd like to thank you again for joining us here. Thank you so much. I know our listeners around the country really appreciate that. And folks, we are looking forward to connecting with you again soon. Catch us on the next Breakthrough Advisor podcast. Talk to you soon, everybody. Take care.
Thank you for listening to the Breakthrough Advisor podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of InsurMark. The content has been made available for informational and educational purposes only.